Trump is back, and your investments could be at risk if you don't act quickly. His return promises drastic changes in the economy and the market. Are you ready for what's coming? In the next few minutes, I'll show you how to protect your money and discover new opportunities in this new era. With Trump's return to power, economic decisions can take unexpected turns. Investors who aren't prepared could see their finances affected in unforeseen ways. But how can you protect yourself from that volatility? Let's find out. First, let's remember what happened during his previous term. Trump was known for his America First policy, prioritizing the domestic economy, reducing regulations, and entering trade conflicts. This impacted entire sectors. Some industries thrived, while others suffered major losses. Right now, the economy is even more fragile than during his first term. We have high inflation, uncertainty in interest rates, and markets that are highly sensitive to political news. The volatility we could see in the coming months could be substantial. Trade tensions are likely to return, especially with economies like China. If this happens, it could directly impact imports and companies that rely on international trade. Trump has been critical of the Federal Reserve's rate control. If he pushes for a more aggressive monetary policy or intervenes in rates, this could affect market confidence and the returns of certain assets. To protect your money, it's essential to diversify into sectors that tend to be less volatile or that usually have steady demand, no matter what. The health and consumer staples sectors, for example, offer some refuge during uncertain times. Companies producing essential goods like food, cleaning products, and medicine tend to maintain their margins even in tough times. Historically, during times of high political volatility, safe haven assets like gold, certain sovereign bonds, and even some cryptocurrencies tend to maintain or increase in value. These investments can act as a shield, protecting your portfolio against extreme fluctuations. If you don't have a percentage of your portfolio in gold or other safe haven assets, this could be a good time to consider allocating at least 5 to 10% of your investments in this type of asset. Sectors like technology and energy could be greatly affected by policy changes. For example, Trump might push for oil and gas again while imposing more restrictions on renewables. Carefully assess where your investments are in these sectors and whether they align with a possible pro-fossil fuel energy policy. If you have investments in renewable energy and believe there could be restrictions in the sector, consider redirecting part of that investment to more neutral companies or those with less risk of negative regulation. In summary, protecting your investments in this context means diversifying into stable sectors, considering safe haven assets, and being cautious with sectors sensitive to political changes. Every decision you make now can make a difference in the next 4 years. With the changes that Trump's administration brings, it's not all risks. Significant opportunities can also emerge in certain sectors and assets if we know where to look. Let's explore which sectors might benefit from his policies and how you can position yourself to take advantage. During his first term, Trump promoted America First policies that favored domestic production. Sectors like infrastructure and defense received substantial capital injections, driving growth in manufacturing and domestic production. Oil and gas received strong support, along with other industries related to fossil fuels. Now, with his return, these policies could be revived and offer new opportunities in these sectors. With Trump back, oil and gas are likely to be prioritized again, especially with policies to relax environmental regulations. Companies in extraction, transportation, and refining of oil could see a boost. If you're considering this sector, integrated energy companies like ExxonMobil or Chevron could benefit from this policy. You could also look into energy ETFs that cover a variety of companies within this sector, which can help diversify your exposure. Remember, this sector can be volatile, especially if there are changes in international trade relations. Consider the long-term risk. Trump has shown a strong focus on national industry. This could mean tax incentives, fewer regulations, and support programs for manufacturing companies. Sectors like defense and infrastructure construction could receive federal funds or special incentives. Companies that provide construction materials, defense equipment, or heavy manufacturing could be good candidates. Some options include Caterpillar for infrastructure or Lockheed Martin for defense. For those who don't want to rely on a single company, considering a fund or ETF that includes several U.S. industrial sector companies could be a good option. If restrictive policies toward foreign technology companies are reinstated, we could see a boost in U.S.-based technology, cybersecurity, hardware, and software companies that replace foreign technology could experience significant growth. Cybersecurity companies like Palo Alto Networks or CrowdStrike could benefit if the government pushes for a stricter national cybersecurity policy. Additionally, U.S. chip and hardware manufacturers, such as NVIDIA or AMD, could also see an increase in demand. Consider a U.S.-focused tech and cybersecurity ETF if you want to diversify. It's a good way to gain exposure to this sector without depending on a single company. If trade tensions with certain countries increase, some emerging markets could benefit from production relocation or shifts in supply chains. Funds or ETFs focused on diversified emerging markets can be an interesting alternative in case trade tensions affect the global economy in unexpected ways. Some companies outside the U.S. that export certain goods to this country may be affected by tariffs or trade policy changes. If you know companies with strong exports to the U.S., it might be wise to monitor their performance. Identifying investment opportunities in a political change context can be challenging but also advantageous. By positioning yourself in strategic sectors like energy, domestic industry, and technology, you can be well-positioned to benefit from this new economic landscape. Trump's return has immediate effects on the market, and the initial movements in the coming months can give us an idea of what's to come in these 4 years. Having a clear strategy for the next few days and weeks can make a big difference. After Trump's victory, the market usually reacts with quick movements in certain sectors. Some investors will bet on favored sectors like energy and industry, while others may sell assets more sensitive to regulations, like renewables. Watch how major indices and sectors react in the first few weeks. Initial volatility can offer buying or selling opportunities, but caution is needed. The first 100 days are typically decisive for an administration, and Trump will want to make his focus clear. During this period, we may see changes in taxes, regulations, or trade agreements that will directly impact several industries. Monitor announced policies, especially those related to foreign trade, infrastructure, and regulations. As policies become clearer, you can adjust your portfolio with greater certainty. Trade tensions with certain countries are likely to return, which could affect sectors dependent on foreign trade, such as technology and manufacturing. If you have investments in companies with a strong dependence on foreign trade, assess the risk of each one and decide if you prefer to keep them or move part of your capital to less exposed sectors. In times of high uncertainty, having liquidity or low volatility assets gives you flexibility to take advantage of opportunities and protects you against significant losses. This could be a good time to increase your cash reserve or invest in short-term bonds. Maintain between 10% and 20% of your portfolio in cash or low volatility bonds. This will allow you to move quickly if the market presents an opportunity. As we discussed earlier, sectors like energy and domestic manufacturing may have an advantage in this administration. However, choose companies with strong fundamentals that can withstand volatility. Consider large-cap companies in these sectors, as they tend to have more capacity to adapt to political and economic changes. Also, investing in sector ETFs for energy or manufacturing can help diversify your exposure and reduce risk. If you have large positions in renewables, foreign technology, or any sector that could be negatively affected by Trump's policies, you might consider reducing your exposure in these uncertain times. Evaluate the profitability of these investments and decide if it's worth reducing a percentage to allocate to safer sectors or temporary shelters like bonds. Under an unpredictable administration, the ability to move quickly is key. Keeping part of your portfolio in liquid assets will give you the freedom to react to unexpected changes. Don't stick to a single long-term strategy. Review your portfolio every quarter, adjusting your exposure according to the evolution of policies and market conditions. Trump's return involves immediate opportunities and risks. With a well-planned and flexible strategy, you can protect your capital and be ready to take advantage of any market movement. It's not just about reacting, but anticipating what's to come. I hope this guide has given you clarity on how to protect and grow your investments in this new scenario with Trump's return. Remember, the key is to act with strategy and anticipation. What do you think? Which sectors seem the most promising to you? Leave it in the comments, and let's share ideas. And if you want more content to protect your finances, subscribe to the channel and turn on notifications. See you in the next video.